Today, we're looking at two financial tools retirees often hear about when they need cash: life settlements and reverse mortgages. How do they compare, and what should your potential borrowers who may be considering a life settlement know first? We'll dive into all of this right after this short message from our sponsor, Liberty Reverse.
Liberty Reverse wants to help you grow your reverse mortgage business with our proprietary Equity IQ product suite. Equity IQ gives your borrowers access to more funds, lowers their upfront costs, and expands eligibility for home purchases. Learn more at partners.libertyreversemortgage.com today. This ad is intended for mortgage professionals only and is not a consumer solicitation. PHH Mortgage, doing business as Liberty Reverse Mortgage, is an equal housing lender. NMLS number 2726.
Welcome back, and thank you for joining us. More seniors are looking to their assets to supplement their monthly cash flow and perhaps retire some monthly loan payments, and two options are typically considered. One gets quite a bit of TV airtime. Think of those J.G. Wentworth commercials. And the other, it allows an older homeowner to tap into a portion of their home's value to supplement their retirement cash flow without payments. So what's interesting is how often each option is actually used. In 2023, there are only about 3,000 life settlement transactions completed nationwide. And by comparison, that same year saw about 50,000 FHA-insured HECM reverse mortgages endorsed. And that gap alone tells us something important. While life settlements are highly visible, they're a niche solution, even more so than a reverse. So yes, reverse mortgages are far more commonly used by seniors to access cash, but what is a life settlement? It's an arrangement where the policyholder sells their life insurance policy to an investor for an agreed upon lump sum payment. And then the investor will make all of the future premium payments, but then will collect the death benefit when the policyholder passes. Life settlements typically offer 10 to 25% of the face amount for the death benefit. For example, a policy with a $500,000 death benefit would likely be $50,000 to $125,000, depending on several factors. And payouts tend to be higher for a policyholder in poor health. Now, life settlements are generally making sense for those who can no longer afford their premiums, which would lapse the policy, leaving no monetary benefit. However, for those who cannot afford the premiums but do wish to continue coverage to protect their spouse or family members, funding those premiums with another source of cash may be the best choice. Unlike a life settlement, a typical 70-year-old reverse mortgage borrower can access 45 to 55% of their home's value up to the HECM limit, and more importantly, they may not need to sell their policy for a fraction of the death benefit. So here's one example to consider. A married 70-year-old homeowner with a $450,000 home and no mortgage balance uses a reverse mortgage line of credit strategically, not for spending, but to preserve a life insurance legacy for his wife. By drawing just $250 a month from the HECM to cover premiums on a $500,000 life insurance policy, the homeowner advances about $30,000 over 10 years. And then when you include roughly $16,000 in finance closing costs and the accumulated interest at an assumed rate of 6.75%, the total reverse mortgage balance after a decade will be about $67,000. Now, if he, the homeowner, passes away in year 10, let's say, the reverse mortgage will continue for his wife. However, his wife, as the beneficiary of that policy, will receive the full $500,000 tax-free death benefit. And that will leave the family more than $430,000 ahead, even with the reverse mortgage. And it would even be more advantageous, let's say, if his wife was an eligible non-borrowing spouse who would lose access to the HECM line of credit or the monthly payouts from a 10-year or term plan. So in effect, a relatively small and controlled use of home equity is being leveraged to protect a substantial inheritance that might otherwise have been lost if the policy had lapsed or was sold at a steep discount through a life settlement. And it's most importantly providing an eligible non-borrowing spouse with a source of much needed cash when she needs those funds, and those HECM funds are no longer available. So considering our hypothetical scenario today, perhaps it may be wise to ask a potential borrower if they do have any life insurance policies in force and if they are struggling to make the premium payments on any of them. Now, if they are, the HECM may be the superior solution to a life settlement. And most importantly, unlike a life settlement, the homeowner is not going to be selling their home or surrendering its future value for a small percentage of its present price. And they're just simply borrowing against a portion of their home equity while retaining home ownership. So what do you think? Life settlement, reverse mortgage? Have you ever run into this situation where an individual has used a reverse to continue paying their life insurance premiums? Please let us know in the comment section below. And if you'd be so kind as to share this week's video on your LinkedIn network, we thank you for doing that. We do have a YouTube channel. Be sure to subscribe and hit the notification bell. That way, anytime we have new content, you're notified right away. If you want to catch up on the most recent reverse mortgage news, we invite you to our weekly podcast, HECM World Weekly. We have both an audio and a video edition. Listeners can listen and subscribe on Spotify and Apple Music. Thank you so much for joining us again today, and be sure to return next week for more reverse mortgage news, commentary, and analysis you'll only find right here at HECM World. Have a great week.